Hello, good morning. I am Amnish Jain. Welcome to the Fixed Income Monthly Outlook from Canara Robeco. Let us take a look at the global landscape. Global geopolitics continues to remain volatile. The Middle East situation flared up again last month when Israel and Iran traded airstrikes on each other's territories. Fortunately, it was only a one-off strike from each country, and the situation has been quiet after that. Unfortunately, because of this escalation, the Middle East tension continues to remain volatile. Ukraine-Russia war, which has been going on for now almost 2 years, continues to remain volatile, and with the latest US releasing funds for both Ukraine and Israel, the situation will continue to remain tense. The US Senate approved $90 billion of funding for both Ukraine and Israel in the recent past 1 week. This will continue to put pressure in tensions in the Ukraine-Russia war as well as the Middle East. Coming to macroeconomic scenario, US labor data has continued to show an uptick in the last few readings, while the inflation has shown upticks in the last few readings as well. Inflation now is about 3.7% in US compared to about 3% in December when Fed declared war over inflation to being over. This has led to large volatility in bond markets. US rate cuts, which were expected to be 6 to 7 at the start of 2024, are now barely expected to be 1 or 2 after the spate of very strong data seen in the US. US Federal Reserve officials also have backpedaled on rate cuts, and the recently concluded FOMC, or the Federal Open Market Committee, decision also has been that they will continue to look at data, and there is no timeline now on the rate easing happening in 2024. However, the US Fed officials believe that the disinflationary process is well underway and financial conditions remain restrictive enough for them to control inflation, and growth continues to remain robust. In the meantime, the bond markets have moved upwards. We have seen US yields climb from 4.30 at start of April to 4.70 at the end of April. This is for the US 10-year. There has been a drastic change from what was at the start of the year in 2024. In December, if we remember, Fed has pivoted to an easy policy, and that time the markets rallied a lot. US 10 years dropped to about 3.8% in December, and now it's almost 100 basis higher at about 4.6 to 4.7%. This has led to impact all over the world, and especially also on Indian markets. Coming to India, the Indian economy continues to show remarkable resilience. Growth continues to remain strong. Look at any of the high frequency data like auto sales, cement dispatches and all, they remain on positive side. Inflation has also marginally been coming down month on month. Last inflation number was 4.85%, which was still above RBI's target of 4%. But if we look at the core inflation, it has been showing good disinflation and is now around 3.3 to 3.5% in last few readings. However, RBI continues to remain cautious. In the policy in April, RBI continued to pause on rates and stance also remained unchanged. RBI is slightly worried on inflation because of food prices. Food prices tend to be volatile in summer months. Also, because of the Middle East war, the oil prices tend to remain volatile and remain a cause for concern for the RBI. From a growth perspective, RBI is in a very sweet spot, and inflation has been trending lower, though at a very slower pace. From RBI's perspective, there is no hurry to cut rates. We also expect that RBI will now move slowly on rates, and we do not expect any rate cut in the near term. This is because the US Fed has also pushed back rates into the second half of the year, and the number of rate cuts are also become much lower than what was earlier anticipated. We probably expect now a 25 basis rate cut in FY25 from RBI, compared to probably 50 basis rate cut which may be delivered by the US Federal Reserve. In this scenario, rates may remain range bound for some time. On the positive side, the flows from index inclusion, which will start in June of 24. This is the bond inclusion of Indian government bonds into JP Morgan Emerging Bond Index, which again is expected to bring about $25 to $30 billion in next 10 months by end of March 25. So this will give a good support to Indian markets in the near term before things become better, as growth probably will slow down in US and Fed will have the option of cutting rates, start cutting rates by the second half of 2024. Indian 10-year has been fairly quiet. In the last 1 month, it has been fairly quiet between 7.10 to 7.20 range. We expect it to remain in the range in the near term. What does it do for the investors? Since there is no expectation of rate cuts, investors should choose to invest in funds which can give you accrual in the short term, and then probably in the longer term they can look for more capital gains if and when the rate cut cycle starts. From that perspective, if an investment horizon is about a year or so, investors can look at low duration products which provide good carry and accrual with a very minimal duration exposure of approximately 1 year. These funds invest in money market and bonds with an average overall portfolio maturity of about 0.5 to 1 year duration. This is a good product for investors looking to invest for the short term or accrual basis. If an investor is looking for an investment horizon of say 1 to 3 years, a banking PSU product provides combination of both accrual as well as medium duration. Investors will benefit from the accrual, and as and when a rate easing starts, they should also benefit from capital gains which may happen when rates go down. Overall, the scenario in near term remains very, very volatile. Though on the rate side in India, we are fairly comfortable that rates are range bound. One, because inflation in India is much lower than what compared to US from the target. Second, growth in India is fairly stable, and we do not expect RBI to be unduly worried on either inflation or growth. So from that perspective, rate market should be remaining in a range. Liquidity will be two-way depending on inflows and outflows on the FX side. So that is what liquidity should improve going into second half, and that should also be positive for bonds. As usual, investors should invest according to their risk and return profile and their investment durations. Thank you. Goodbye.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.